let's say that you were only allowed to invest in Coca-Cola or Pepsi. That's it.
Yep.
Well, you go to Goldman Sachs and you get a report on Pepsi Cola, and it's the greatest company since sliced bread. Thick report written by a guy, PhD from Yale. I mean, three-piece suit, everything you could want. Who's going to read it? But you can look at the chart and go with it. But then I go to Morgan Stanley and get a report on Coca-Cola, and Coca-Cola, best company you could possibly invest in. I mean, it's the product of America.
Mm-hmm.
Well, which one am I going to invest in? Both of them are fundamentally sound. So I got to put them through an arm wrestling contest. And here's the way you do it. To create a relative strength chart, you divide one thing by another. So in other words, let's pull a couple numbers out of the air. Let's say Coca-Cola is at 100, which is not, and Pepsi is at 50, which is not. If I divided 50 into 100, that's Pepsi into Coke, I get 2 because Coke's 100, Pepsi's 50. Then I add a 0 to make it easier to chart. So I chart that on a point and figure basis. On that point and figure basis, when I chart that, it's not a price chart. It's a relative chart between the two of them.
Yeah.
And it shows me which one, when it's in a column of X's and rising, exceeding, when it's on a buy signal and rising, you own the numerator, plain and simple. When it's on a sell signal and declining, you own the denominator. And I wouldn't have a problem at all. When that relative strength chart switched from one to the other, I would have no problem selling one and buying the other.
Yep. So now when you're looking at, so you go to an industry group, the oil and services group, you're choosing the top 5 or the top 5 stocks in whatever sector.
After they've all arm wrestled each other.
They've all arm wrestled each other. Now it's giving you have the top 5 here. How
Right.
often do you switch that out? Is it a kind of on a monthly basis, or are you letting the market and the stocks themselves handle it?
Rusha, the market handles it. I mean, who am I to put those 5 in and then say, okay, I'm looking at this and say, well, we got a problem with Ukraine, and we got a problem with the nuclear stuff. We got a problem. No, hell no. When that indicator changes, I'm changing.
Yo.
I don't have to do anything else. Period. So like in Indonesia, when a change takes place in my portfolio there, they do it automatically.
Wow.
Why? Because they're tied into Dorsey, Wright, and whenever the change comes up, they send the change to them.
Yep.
This is, I mean, you should be able to run $1 billion portfolio from a cruise ship with an iPhone. Plain and simple.
Now you do give it a little bit of room, though, right? So if it drops from number 5 to number 6 or number 7, you give it a little bit of room, kind of like a baseball pitcher, right?
Exactly. I'd let it go to number 10.
Okay.
Now you could set up your own system the way you want it. But number 10 is like that pitcher who walked too many people, got too many home runs hit off him, too many things accumulated when the coach had to come out and take him out and bring a new guy in that's been warmed up.
Yep.
And that's what happens. So you give the stocks room to drop from number 5 to number 10, and that's the pitcher, blowing it and having to go into the dugout. But once you get down number 10, then you're going to make that swap.
Okay, and then number 6 goes up to number 5 or something.
Number 6 goes in.
Okay.
Yeah, and again, it's just that simple. Again,
and relative strength is long term, Rusha. Relative strength can last 2.5 years.
Yeah. Yeah.
And again, you're using that point figure kind of to just guide you in terms of when those changes are happening, the reversals, the trends, right?
That's right. Because that's all you're going to look at when you come to work each day. You're going to look at, let's say, your favorite sectors that you like. See the calculations on the relative strength that are done every night, and see what the top 5 are.
Yep.
So now, Tom, you were mentioning kind of in the last segment, you started to talk about it a little bit, and maybe we could get into it a little bit more. The strategy that you're using now, with closed-end funds, and
okay,
let's get into that a little bit.
Great. That's important. The people that I deal with closed-end fund is Susan Horowitz, and it's called Big Whale, their company. So go search them, Big Whale. They're the best in the closed-end funds. I learned about closed-end funds by accident again. Everything happens by accident. This lady came to me and asked me if I could help her market her closed-end fund business.
Mm-hmm.
Well, I looked at it. I thought, this is really cool what she's got here. I said, this, and I'm thinking to myself, people 75, do I want my pie in the sky anymore? Or do I want it on the table?
Yeah.
I want it on the table. And I want to start spending my income. I don't need to make more income to give to the kids when I die. That's for me and my wife.
Mm-hmm.
And that's what we do with the closed-end funds. They're very high yield. They're low volatility. But the interesting thing about the closed-end funds is you can margin them. So I have a portfolio of closed-end funds that I put on margin.
Mm-hmm.
And then what I'll do each day, and this is only because they changed the rules and options last couple of years, where they have 1-day options. 1 day. They come
They
in the
expire
morning.
in a day. That's
That's
all you
it.
get.
4 o'clock, they are history.
Uh-huh.
And it's like going to Coney Island and getting an ice cream cone at 9 o'clock in the morning, and you stand out on the sand all day. It's July. And you watch that ice cream cone melt. That's called theta.
Yeah.
That's what I want.
Time decay.
I want the melt. I don't want to be a hero. I don't want to be, some kind of great trader or anything like that. I just want the melt. So I want, at the end of the day, to increase the value of my portfolio, or at least mitigate any losses that I have in it. So I keep the portfolio stable. If it's the best thing I can do is keep it stable, great. If I can make money doing this, then I do. And typically that's exactly what happens.
And so, Tom, what options are you trading? So you're taking the margin from the closed-end fund. What options are you trading? What are these daily options that you trade off of?
Here's what I do. Here's what I do in the morning. First thing, I get up in the morning, and I can't wait to get in. Because once the market opens, I just love it.
Yep.
And the option market, what I do there is it's naked straddles and naked strangles. And what's a naked straddle and a strangle? A naked strangle is something that I do every day. And let's pull out a number. Say the S&P's at 3,000. Make that number.
Mm-hmm.
I'll come in the morning, and what I'll do is I'll sell a 3,100 call, and I'll sell a 2,900 put. Those are my goalposts.
Yeah.
So I'm going out on my football field. I'm setting my goalposts, and I'm praying that the game is played between the goalposts.
Mm-hmm.
If it's played between the goalposts, I'm on Coney Island with 2 ice cream cones.
Yeah.
And that's called theta, and that's melting. And it happens so fast. It's so interesting once you understand this. The key to not losing money doing this is don't over leverage. Over leverage is the kiss of death.
Yes.
You can do these in a portfolio. Let's say you get qualified to do uncovered strangles, and you're going to put 1 contract on a time. That's it. 1 call, 1 put. Those are my goalposts. And then I'm going to pray that this day stays between those 2 goalposts. If it doesn't, I have to move the goalpost.
Okay.
So all days I'm moving and grooving with this, but the days that are great is when you sit here. It's Maytag Repairman days. Do you remember the Maytag Repairman?
Yeah, I do. Yeah.
Yeah, doing nothing, right?
That's what we want. This is the Maytag Repairman strategy.
Uh-huh.
Is when you put this on, you want to sit there like this guy just all day. Nothing happening, man. Because I got great washers and dryers, and they don't break.
Yeah. Now, when you've got a more volatile market, in order to get it to stay within your range, are you kind of making wider goalposts? Do you change the distance between those goalposts depending on your market?
I will make the goalposts as wide as I possibly can. Okay. And that will dictate what the VIX is, the volatility index. The more volatility, the wider I can be. Because I'm not interested in getting in the ring and throwing blows on anybody. I'd rather get in the ring and just have both guys sit there and wait until the 10th round and say, okay, guys, see you later. I'm out of here.
Let's take our money.
Yeah, let me pick up my check. I'm gone.
Yeah.
But that's what I do. The key to it, though, is when you think about what I started doing is trying to create an income stream to an individual who understands this and is willing to do it. And you don't have to have a lot of money to do it. Do one contract at a time.
Yeah.
And you're going to do two contracts. One is going to be a call. That's one of your goalposts. The other is going to be a put, one by one. Nobody gets hurt, but one by one, you could make yourself $700 a day, and that's $140,000 a year on 270 trading days. That's not bad for somebody who's willing to do one lots.
Yeah. Yeah.
You know, you come in, put your one lot on and make it wide as you possibly can, and go have breakfast.
Yeah.
Now we have to ask about the risk management side, because sometimes you're going to have those days where, man, that ball just went right out of your goalpost. You know, some news came out, what have you, and it's right out of the goalpost. So
we have had that happen in the last couple of days. Look at the way the market has gone last couple of days. That's exactly what has happened. Mm-hmm. But by the next day, something else happens, and you have lost a day of time value. You see? So what I'll do is, people don't want to do what I do. I'll do 30, 40, 50 contracts at a time on each side.
Do not try
That's
this at home.
dangerous. You better know what you're doing to do that.
Yeah, for sure.
But if you're doing one contract, and let's say you're looking to make $500 a day, 500 times 270 days, that's not a bad piece of change for somebody.
Yeah.
And we're talking one lots.
Yeah. Well, so like anything else, you start small and slowly learn,
That's
over
right.
time, right?
And just like you're saying there, Rusha, is leverage.
Absolutely.
Excess leverage is the kiss of death in this.
Yep.
Because all of a sudden you're used to one lots, and then you do a 10 lot.
Yeah.
And oh Lord, something bad happens, or something good happens. You do a 20 lot, then you do a 30 lot, and then it gets out of control. The idea is to set up the concept of what you want to do. You want to make yourself $150,000 a year. This is it.
Mm-hmm.
Mm-hmm.
You want to make $200,000 a year. This is it. Stay at least till 12 o'clock in the afternoon.
Mm-hmm. So now this is with the strangle.
Yes.
With the straddle, you aren't really having goalposts on either side, because again, like a call that you're selling at a higher price and a put that you're selling at a lower price. With a straddle, you're kind of using the same strike price. So
exactly,
what is it that you're doing there differently?
That's a great question, because the straddles come into play more toward the end of the day when the volatility starts picking up, and you've probably experienced all the theta that you're going to get from a position. Then it becomes delta, i.e. volatility. Mm-hmm. And by that time, you've already lost enough premium. You're going to pick up $400 or $500 in that day. Mm-hmm. And multiply that times 270 trading days a year. Person could go to Tahiti and relax for 6 months.
Right. Now, was this some of the stuff that you were writing down on the yellow pad years ago in the 70s when you were kind of putting all this together?
No. I never thought about this.
Okay.
Back in the 70s. The only reason I thought about this is when they changed the rules and they made one-day options.
Okay. Mm-hmm. Okay.
That changed the ball game for me.
Yeah.
One-day options, when I can get into it and out of it by the end of the day. Now, here's the interesting thing, too, is the government gives you a tax break on this. If you're trading index options, just like index futures, it's a 60-40.
Wow. I didn't
know.
So
60% of your gains are going to be going to be long-term. 40% will be short-term. So you get a great tax break doing it.
Yeah.
So that's another reason why I do the indexes. Plus, the indexes are so liquid, you can get in and out in a half a second.
Yeah.
So what I'll do is I'll put a position on. Let's say S&P 500 is at 3,000, and I'll sell 3,600 and a 35-40 put, 3,600 call. If I do one by one, which I do every day, because I'm trying to build this concept of a person having an income doing this. I do this every single day. And I would say 90% of the time it works out well. Sometimes it doesn't, and the market blows past you and you end up with a $1,500 loss. That's okay. That's life on Wall Street.
Right.
You're going to make that up.
Right.
That's going to come on the next good day.
Yep.
But you're only doing one contract at a time. So you're not going to be out at dinner and I wonder, oh God, if you take home a 20 lot,
yeah,
you ain't sleeping.
Right. Right. But that's what a lot of people do, though, right? I'm sure you run across tons of clients like that over the years who they would just jump and they would over-lever themselves and get themselves too much into trouble.
That's right. It's over-leverage that's the killer.
Yeah.
And it's like Jim Yates, who was my mentor many years ago, great option guy. He wrote the book, The Option Strategy Spectrum. His concept was, whenever you buy a call, he says, hold it till expiration. Never trade it. So you don't over leverage to begin with.
Yeah.
If you're normally a 300 share buyer, you buy 3 calls.
Right.
And you hold them until expiration.
That's interesting.
Now there's no tension. And no over leverage because you're not doing 30 calls.
Right.
That's where people have to get to the point where I have to do something because otherwise I'm going to lose my shirt. Yeah,
right. Exactly. This way, when you're not over leveraged, it doesn't matter because it's going to go off the board at the end of the day. It can go right into the computer system. You don't even have to be there. At the end of the day, the system just adds it all up and takes it.
So just to kind of sum up,
this is beautiful.
Oh, yeah. So, one last thing, because you've mentioned SSO a number of times. So one other strategy that you're doing sometimes is you're using those closed-end funds. You're margining those because that's kind of your pie on the table, your stable part, and then you're getting the extra income from either these options, or sometimes you're just going with SSO, which is the ProShares Ultra, 2x whatever the S&P 500 does on a daily basis. That does twice as much, up or down. And why is it you prefer just kind of sticking with the indexes in this case? And again, part of this is going a little bit more conservative.
Because sticking with the indexes, you don't have that problem of one stock coming out and saying, we have bad earnings today and we're down 30%.
Yeah.
That ain't happening with the S&P. And when you're doing 1 days, it doesn't matter to you whether the market's going up or down. It's of no consequence whatsoever. You want to set out your goalposts and try to get the game to play in the middle. And if you have to move your goalposts, that's okay, but don't over leverage. And you're going to come out ahead, and you're going to have a lot of fun doing it. Believe me. Now, like you said, on the straddle, it's very similar to picture your car driving down the road, and you got your 2 wheels here, and you're right over that middle strip on the road. Okay, that's your straddle. But then all of a sudden, you can pull a lever in your car, and your wheels will go out to the edges of the road. That's your strangle. Okay. So I get less money out here, but I have less risk. I want less risk. I can make up the money.
Yeah.
I don't want the risk. I want to get as little risk as I possibly can, and then just accumulate that each day. And you have 270 trading days. So whatever you can make in a day, multiply times 270, and that's your potential for the year.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.